some bit of pressure. We should try and pull up Nifty. So it's come off the highest point of the trading session. But is that going to be the nature of the market? That's something Abhay Agarwal will talk to us about. He's, of course, the founder and fund manager at Piper Serica, joining us on the show right now. Hi, Abhay. Good to be speaking with you. And to begin with, Diwali greetings, because it's just 1 week away. What's your sense? Is it going to be a bit of a soft Diwali for us?
Yeah, good afternoon, Anisha, and happy Diwali to you and all the viewers. Uh, it is looking like I think we saw some of this trend starting to come up. Low consumption, weak consumption, the Diwali stocking that typically used to take place with the retailers and distributors of products that focus on consumer discretionary demand like paints, tiles, home improvement, autos, especially. There was a very weak offtake. There was already a lot of channel inventory that was not getting absorbed. So there was already nervousness that the consumption figure will be lower than earlier years. And I think as we come closer to Diwali, we are not seeing any significant pickup in demand. So and also the earnings numbers that we have seen so far come out are not very encouraging and are kind of pointing towards a cyclical downturn. It's not a structural downturn, but we have had a one-way rally in GDP growth, economic growth since COVID. So I think some bit of cyclical downturn is expected, which is what we are going through. I think it will reflect in terms of softening of valuations of the market. So I think what we are seeing in the market, a buy on dips market changing very quickly to sell on rallies. I think this will continue to be till there are clear signs of a cyclical upturn and consumption coming back and earnings growth coming back, Anisha.
How long will that take as per your channel checks and your understanding? And also given the fact that you have still maintained the cash levels at around 20%, this definitely means that you're expecting furthermore correction in the market?
We are not, again, to be very clear, we're not building in a very sharp correction in the market. I think the valuations froth has its own way of finding its way out, and the longer it takes, the better, because it doesn't scare investors. It gives people an opportunity to reallocate their capital to emerging sectors. So we are holding cash and we are starting to deploy it gradually. Not because we are expecting a very sharp correction. If it comes, it comes. We are not really building towards that. But we are holding cash because we are migrating our portfolio away from some themes that have worked earlier, like banking and financial services, autos, capital goods, and getting overweight into sectors that we see earnings come in, and these sectors are still not as expensive based on the expected growth. Some of them, like insurance, metals, some of the pharma names, I think, are still very attractive with a 3 to 5 year perspective. So I think our cash holding is more to facilitate that sectoral churn as we, rebalance our model portfolio.
Okay, but then from when do you plan to deploy this cash that you have? Because 20% is a very high level, I believe, when it comes to cash, right?
We have had that in the past also, and I think we hold that cash and we deploy it over 2 to 3 months. So I think we would have deployed our normal cash holding in the model portfolio is about 5 to 6%. I think in a couple of months' time, I think we should get there.
Couple of months, and perhaps we'll see some sort of semblance, and that is the time you'll start deploying. But I wanted a better sense from you regarding the IT sector, because the earnings of mid caps have been pretty okay. The large caps were also in line with expectation, but the stocks have run up ahead of that. What's the view on IT at the moment?
I think we'll break up IT into two parts. The larger companies are still focused a lot on time and material model, the services model. And I think that's where there is a slowdown in growth, because the customers are clearly moving towards a fixed pricing model. So I think the large companies have been guiding for growth of anything from 1 to 5%, which to me as an investor is not really that exciting. I still don't see why should we be paying a multiple of 25 to 30 times when the companies are guiding for a sub 5% growth. At the same time, the mid cap IT companies and some of the small caps also have been more focused on product innovation. And I think that is where they are going through this higher growth and better margin profile situation. So I think the opportunities are more in the mid and small cap IT space rather than the large cap IT space, because the large cap IT space will pick up as these companies will find a way to restructure their model away purely from time and material pricing models. I think that should happen over the next year, but there will be plenty of opportunities for investors to add the large cap IT names to their portfolio, but definitely worth keeping an eye in the mid and small cap IT services, IT companies.
To keep your eye out on that sector and segment. But Abhay, am I reading it right? Are you expecting Nifty to head around 21,600? Because
that is not our expectation. I mean, that is just a mathematical correlation we did, because before the earnings season started, the consensus estimate of Nifty EPS for FY26 was 1,252 rupees, and it's already down as the earnings are coming through, down to 1,215 rupees. And our expectation is that this will fall to below 1,200 by the time the earnings season is over. Earlier we were looking at a 20 times P multiple to 1,250 rupee EPS, which was about 25,000 Nifty level was a fair level. But what happens is in a situation where earnings are getting downgraded, and from 1250 EPS level for Nifty, you go down to 1200. There is an automatic adjustment of the P multiple also, and our P multiples are, quite high or at a premium when you look at what global investors have and as an opportunity space. So it will not be out of context for the P multiples to also adjust to 18 times forward. So if you just look at 1200 EPS multiplied by 18x, the outcome is 21,600 at the Nifty level. So we are not expecting or we are not forecasting it will get to that level, but all we are saying is that, look, it is not out of probability that it gets there before it recovers.
Well, thank you, Abhay, for joining us and for giving us all those details and for putting things into perspective.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.